So in trading, you really want to understand the assets you're trading, right? You want to know them. You want to know what moves them. You want to know what affects them. You want to know what drives them. You want to know what causes them to move, because it is in those moves that you make money. For a lot of people, when they get introduced to trading, they basically see it as a random market to which all they need to do is to determine if prices are going to rise or if prices are just going to fall. Like they don't care about what they trade. All they know is Euro USD. Is it buy or is it sell? Like they don't even know what Euro is. They don't know what contributes to the movement of the Euro. They don't know what happens to the dollar, what drives it up, what drives it down. You know, what contributes to its movement per se. You see, and that's why we're about to change that. We've decided to have a series of, topics for you dedicated to talking about really understanding how to trade, individual currencies in the market, helping you see those currencies for what they are. And we're starting it with USD and the USD index today. So ladies and gentlemen, once again, welcome to this webinar session. My name is Emmanuel Akola, market analyst at HFM Nigeria. And with me, we're going to be here for the next at least 1 hour, talking about this topic and see where we can get to and, make a very good progress in the session today. Without wasting so much of our time, everybody knows dollar, the US dollar. I mean, just yesterday during the live session, and we're during the live session of, CPI, we were just discussing, what assets to analyze in lieu of the US CPI. And then you could see people mentioning Euro USD, Pounds USD, USD JPY, you could see varieties of, instruments that people were just looking for analysis on. But also, if you also check the charts, you would also see that a lot of people were also mentioning some other assets. US 30, US 100, US 500. Some people also mentioned BTC. Some people even said, go and check gold. Let's check US oil. Now, the information itself was for the dollar. So how come we're talking about the effect of CPI on assets like BTC, on assets like, US 30, US 100, US 500, on other assets in the market like US oil, like copper and the rest of them? Why is it not limited to just, currencies? Why can't it just be limited to Euro USD, maybe Pounds USD and USD JPY? It's because you need to understand how big the US dollar is in the market. You need to understand the kind of influence it has on the general market. Dollar informations are not random. They can do a lot. So it is something that you really want to understand. It is the most widely traded currency globally, not even just, within Nigeria as a space. Globally, the US dollar is the most traded, currency in the world. It is also the world's foremost reserve currency. Yes, it's the world's foremost reserve currency. It's as big as they come. And its effect can always be felt across different asset classes. I'm talking about the effect of the dollar on the currency market, on the metals market, on the energies market, even on the stock market, on the indices market. The bonds market is not left out. It carries that much power. And what gives it that much importance is because of its place as the most traded currency in the market. the word reserve currency, almost every product that you have is priced in the dollar, which means it gives off more effects or distribute effects to some of those assets in the market. Its place is not just random. It's really serious. And that's why it is important for us to know what really contributes to the movement of the dollar. What forms a bigger chunk of what you really need to know when it comes to trading the US dollar. The first thing we're going to be discussing today, especially when it comes to trading the US dollar, is the place of its fundamentals. You see, the fundamentals of dollar is important. And specifically talking about the central bank aspect. The central bank aspect is the most important thing you must know when it comes to trading the US dollar. It is so important. The decisions of the central bank would play a major role in how you expect the US dollar to, react in the market, either in the short term, in the medium term, or even in the long term. So you must get comfortable with US dollar information. You must get comfortable with information coming from the central bank. You must get comfortable with analyzing such information. The Federal Reserve is the official central bank in the US. And decisions made from the central bank would always play a significant role in the determination of the value of the US dollar in the long term. It is one thing that you always need to pay attention to. And specifically, not just the decision of the central bank, you also need to focus on interest rate decisions. Interest rate is the biggest factor, to consider when it comes to policy making for any central bank. But also when we talk about the Federal Reserve, interest rate is one of the biggest things to understand. And why is it important? Because the problem of achieving price stability is focal for the Federal Reserve. Price stability is one of the most important factors to the Federal Reserve. And in order to achieve price stability, it means they must always look to get inflation under control, or possibly also get deflation under control. Let me give you a timeline of what has happened in terms of policies, with the Federal Reserve. You see, in 2020, for those of us who can remember, we had COVID, which means, we had shutdown, lockdowns, and you saw a lot of people were, asked to go inside, maintain social distancing. And then what happened was, natural, if people are not buying something, it is expected that there's going to be a fall in price. So we saw what we call deflationary pressures during COVID, which means what happened as at that time was COVID caused lower inflation, and then for the central bank to help the currency pick up once again, the Federal Reserve, had to come up with some really interesting policies. For example, the US introduced monetary stimulus. They started paying, people unemployment rate benefits, COVID stimulus checks. Not only that, the central bank had to follow with a significant cut in interest rate. So as inflation dropped, interest rate also had to follow to help the economy pick up when it was time to reopen. So as inflation dropped, we started getting inflationary policies, the central bank had to put up some really interesting policies to help the economy pick up again. But then the economy started picking up again in the year 2021, 2022. And then if economy is picking up, economy is growing, what follows is naturally an increase, in inflation. So we saw inflation increase so much in the US, and what followed was a corresponding increase in interest rates. You must have guessed by now what happened. This movement weakened the dollar, but this activity, strengthened the US dollar. Which means, under normal circumstances, if we find interest rates moving lower because inflation is going down, its natural way of affecting the currency is to make the currency weak. But at the same time, when we find, inflation rising and interest rate is expected to climb alongside, it strengthens the currency. Now, this was what happened, during COVID, and this was post-COVID. But now, what is currently happening? Now, interest rate has gone up so much, about 5.50% in the US, restrictive policy. But then, inflation has also been corrected. We have now seen inflation in the US currently drop to about 3% from what we saw yesterday with the US CPI. For those who remember, we had CPI yesterday. Inflation has now dropped to as low as 3% in the US, which means with inflation lower now, under normal circumstances, you should see a repeat of the policy that was used in early 2020 when COVID was still disturbing us, right? Which means lower inflation under normal circumstances is expected to warrant another fall in interest rate, which means the current restrictive policy of the Federal Reserve is expected to cool a little bit. So we're expecting a cut in interest rate. Now, the expectation of a cut in interest rate because of lower inflation rate cut expectations. Remember, they've not done it yet, so it is still an expectation for now. The expectations of a rate cut also means we're expected to have a weak US dollar. Now, listen to this, which means judging by what is currently available in terms of the present situation of the US dollar, inflation is now returning back to target. It's currently about 3.0% with headline inflation, which means under normal circumstances, what is expected to follow is a corresponding fall in interest rate, and that is expected to generate weakness for the US dollar. You see, we've seen it, we are saying it, but how then do you confirm this to be true? Because if I'm using my mouth to say US dollar is weak, based on a set of information, how then do you confirm? How then do you see that this is really what is happening? How then do you visualize the movement of prices, especially in relation to the US dollar, to really see the overall movement of the price of the US dollar in the market? Remember, you're trading in pairs, and you also know if I trade in pairs, right, it means the activity of the US dollar is not going to be enough to really see or predict the performance of the dollar on pairs. Which means if I want to really see how USD is performing, I can't just go to Euro USD to give the overall picture of the performance of the US dollar. Why? Because on Euro USD, it is the market playing out what is happening with the euro and comparing it with what is happening with the dollar. So it means a mixture is going on. But how do I really see, the performance of the dollar individually, visualizing how the US dollar is really performing in the market? That is why we have the USD index. The USD index is now there, to help you visualize this. That is, if I'm expecting a rate cut for the Federal Reserve, which means the USD is supposed to be weak or expected to be weak, how can I see this? How can I see this is even actually true? How can I visualize this movement? And if it is true, how can I also use this to forecast future movements? Here comes USD index. We're coming back to this, but let's visit USD index. This is the USD index. The USD index is an index that, naturally shows the performance of the dollar against a basket of commodities or a basket of currencies in the market, right? So in all honesty, it's a broad measurement, broader than looking at just one single pair, a broad measurement of looking at and visualizing the weakness and the strength of the US dollar. So if I was expecting weakness for the dollar because of a fall in, inflationary pressures, which means I can increase my expectations of a cut in interest rate, I can easily fall down to the USD index to see if this is true. And just by visualizing, by looking at the screen, you can clearly see that the USD index is down, clearly suggesting that the US dollar is actually weak, clearly suggesting the presence of a weak US dollar. So I can visualize that movement. I can now see that, okay, broadly, not just against one currency now, broadly, the dollar is actually a weak currency. Why? The USD index is going down. And not only can it show you the present state of the US dollar, another thing it could do for you is you can actually make your technical analysis on this guy to predict the future movement of the dollar, which means I can do some analysis on this, right? I can bring in some inferences on this. Okay, I want to see how the dollar could possibly perform next week. You understand? Or maybe even the next 2 weeks. Possibly. So I can start analyzing USD index just through technicals. I can begin to see, some certain things. Number one, okay, I can see that maybe where price is currently trading, is a really strong, support level. So I feel like maybe even if dollar is going to be weak, that level might disturb me for a while. It is a support level. And from what you can see, it's really helped price for a while, down, up again, down, pushing it up again, and then it is down again, which means it is natural that this level, disturbs price for a while. I'm not saying price might not break, but eventually price will have to break that level if the weakness of the dollar is expected to continue to take place, which means I can make some inferences for the dollar or the performance of the dollar going forward, even just analyzing the USD index, although it is not going to be enough. I'm just saying it is possible. I can, because of this, say, okay, there's still some possibilities that price can still offer, a little bit of retracement at this level. But if eventually, the weakness of the dollar is still going to hold, it means something like this can still take place. I'm looking at, let me see if I can find a really nice level of resistance, maybe somewhere around here. Oh, okay. There's a really good level of resistance here. A level that used to be, just slightly a level of resistance that became support somewhere around here. So I could make an inference like this, that this could potentially happen to the dollar next week. So maybe something like this. Remember, this happened. It retraced a little bit, then it broke this level. So naturally, a retest of this level will not be bad for price to continue to go down. So analyzing this, I can tell myself, from what I can see on the USD index, I feel like there's a possibility of, prices, dollar regaining a little bit of strength, maybe going into next week, at least until we get to this level of resistance, and then price finds further pressures to head lower, considering that analysis remains the same. You can see what I am doing, making inferences for how I believe the dollar is going to perform by looking at a broader measurement of its strength or weakness, the USD index. So I can begin to analyze the USD index, making inferences to how I expect the dollar to perform, maybe even in the nearest future, maybe even in the following week. It is important. But analysis has to be, the major guide to how you're also going to use technical analysis on this particular USD index to predict, the future movement of the dollar. So let me even assume that I don't know so much about technicals or even the present situation of the dollar. So I want to just read, certain bits of information. I just want to see, some information that are currently, available right now. Okay, now when you look at this, look at this particular information that we have here. What has changed after the US CPI report is the only thing I want to read. What has changed after the US CPI report? The market has started to price in another rate cut in November. Ooh, let's see this. It says, yesterday we got some Goldilocks US data with another soft US CPI report, yes, and good US jobless claim. First of all, better than expected jobless claims should quell fears of a deteriorating labor market, at least in the short term. One thing to note is that the data might have been distorted by the shorter week as we had Independence Day last week. Nonetheless, the next week release should give a better picture, but that's what I'm looking for. It says the US CPI, on the other hand, surprised to the downside, and it was good news across board. Listen, good news in the sense that a weak inflation data means it is okay for the Federal Reserve to consider cutting interest rate without worrying about how the economy is going to react to that, right? So if you look at this, it says, moreover, we saw further easing in the policy-sensitive OER measure, right? Let me see the major thing. Okay, this is the major one I want to read. It says, the market is now basically certain that we will get a rate cut in September and December, but it has also started to price in another cut in November. 3. The market is starting to price in 3 different rate cuts. Let's go back to the USD index. Which means, under normal circumstances, with 3 rate cuts in, under expectations in the market, at least market is a little bit fairly convinced for September and for December, just starting to price in the one of November. But at the same time, what this generally means to me is weakness for the dollar. It means I can expect the dollar to be weak, right? But you also know that technicals still have a play in the weakness or the strength of the dollar. So that is why we are coming to USD index, a metric that can help you see, a broader view of the strength or the weakness of the US dollar in the market, right? So, which means having now in mind that I feel like through information, data needs to be weak from what I've just read, that USD needs to be weak. It means, how can I see weakness for the US dollar? In the first place, we're trading around support territory once again. And ordinarily, we don't want to assume that price is just going to pass. But we've also been able to find, a really solid level of, resistance somewhere here, which means I am fairly a little bit convinced with an higher degree of confidence that if I see this, I expect that there will be a continuation in the weakness of the US dollar, which means it's just like a follow through with price action, something like this. And I just expect this, to happen for dollar to just continue to head lower. So that's my expectation. Even if price is not going to, give retracement back to that level of resistance, I am still going to hold the same opinion of a downside if this is going to happen. At least if price decides to break this region, no problem. If you break, it just simply means this must happen for price to continue to go down. All right, so even if price is still going to, adjust itself, maybe able to give a break beyond this level of, support, it's still fair, it still remains solid. We can just expect, a movement lower for price, and then if we get a retest of the level, price could still have, further downside, right? So it's still one thing that we can still, look out for, but you can see nothing is changing. The only thing changing is how I expect to get in. I'm still seeing downside. What I am still seeing is weakness, but I'm using the USD index as a metric to predict how that weakness can take place. I have information from the central bank. I know what is currently happening. I know what the Federal Reserve Chairman is saying. This is honestly key to what we are doing. So the USD index offers us, a broader view of, the dollar, the weakness and the strength of the dollar, helps you to see and make some certain inferences, especially on the technical side. For example, during CPI yesterday, the dollar was so weak, it was scrambling. But eventually, if you know that you were going to, trade the USD pairs yesterday on the CPI, you would have known that you were not supposed to get too excited, when price got to this level of support. You can see it was going down. But then when it stepped into this support territory, you can see that it gave some reactions. That's not the first time. It won't be the second time as well. So you can always use the USD index to be a metric that you can analyze to predict the weakness or the strength of the USD in the market. It is important. Another major thing outside the central bank aspect outside the monetary policy aspect, the central bank decisions on interest rates, the speakers, another important part of trading the US dollar that you must also know is you must give respect and reference to data. You can't be trading the US dollar and you don't know anything about data that impacts it, or even data that impacts it the most, or even data that generates the most reactions in the market. The US dollar trading and data is too important. It is too important. Let's look at some data. Let's look at data. I just purposely curated, the next, for at least the whole of July. This is what you have in terms of, high impact data from the US. Today, we do have, PPI and UM consumer sentiment by 1 p.m. But this is to tell you that there are some really, really important events, especially on the data end, that you must be really concerned about when it comes to trading the US dollar. Data is important. And when it comes to data, especially with the US dollar in the market, few things must come to mind. Volatility, number one. It's the biggest currency in the market, which means it would also generate some of the biggest reactions in the market. And that means you could also expect that volatility is going to be higher. If you look at this, you see some certain things, right? You can see PPI today, consumer sentiment. You see Fed Powell was speaking. You see retail sales. You can see PMIs, core PC, consumer sentiment again. You can see, FOMC, and then some other really, really key, data when it comes to trading the US dollar. But one major thing that we must hold on to, especially considering the US dollar data, is this. Economic data are actually major drivers of currencies and can affect broader markets. It is too important. Positive economic data will support the currency, and negative data would majorly pressure the currency. You have to pay attention to impact, you have to pay attention to variance, and you must also pay attention to the focus. The impact, that is it high impact? Is it low impact? Is it medium impact? Usually we focus on the high impact data like you've just seen on the screen. Data is one very important aspect of trading the dollar. I'm talking NFP, I'm talking CPI, I'm talking retail sales, PPIs, I'm talking PMIs, both manufacturing, both services, I'm talking consumer sentiment, I'm talking FOMC, I'm talking Federal Reserve speakers like Fed Chair Powell and some other speakers. You see, all of those events, you must bring yourself to a place of conversance with them. You cannot have an economic data for the US coming up and you are nonchalant about it, especially if it's an high impact data. You can't be nonchalant about it. It is going to generate reactions almost across board. And when it comes to data, there is usually a chain of events, that could also be of help to you, when it comes to trading the global financial market. What are we talking about? Listen to this. Where can I do this? Can we get a whiteboard? Okay, let me just do it somewhere around here. Data is key, especially for dollar. It generates quite a lot of reactions in the market, but listen to this. Positive data, good influence on the dollar, naturally should give strong USD. And that means, you know, weak major currencies. And also that means to you, bullish gold, sorry, because it's strong, bearish gold movement, bearish equities like, US 100, US 30, US 500. Let me add something here. Positive data, bullish USD index, look at a complete chain of events. A positive data should generate some bullish reactions on the USD index. Please don't forget, the USD index can also be traded. Ooh, in case you don't know, you can actually trade the strength and weakness of the dollar without worrying about the performance of an opposite currency if it was a currency pair. Like, you can trade USD index. When I expect dollar to be strong, I can be buying USD index. When I also expect the US dollar to be weak, I can also sell USD index without worrying about the performance of an opposite currency. Because when it comes to trading currency pairs, even though dollar is weak, the weakness of its opposite party could still play a part in how the pair is going to react. For example, NZD USD might not move so much, in the terms of a weak dollar, because NZD is also weak. So I would have to be considering, what is happening to the opposite currency, to determine how much of a reaction I can get on a particular pair. But when it comes to USD index, it is strictly just the performance of the dollar being strong or weak, up and down. I can buy USD index. And then if USD index is going to be bullish because prices are expected to be rising, it then gives birth to a strong USD. And a strong US dollar during the point of volatility under normal circumstances renders every other major currency weak. Strong days, not just random data. I mean, days of CPI, I mean, days of NFP, I mean, days of FOMC. On those days, the strength of the dollar naturally will render them weak. The only difference might be in the degree of weakness they are going to have. But naturally, the strength of the US dollar should render them weak. And then that would also give you opportunity to get in on gold. Bearish movement on gold is expected if dollar is going to be rising. I can look for downsides. I can look for downsides on gold. I could also look for downsides on equities, look at US 100, US 30, US 500, look for nice downsides on them. It's a chain of events like that. Especially during, strong economic data for the USD, great impact, high risk impact. But then opposite happens when you have a negative data. So in the case where you have, a really negative data with very nice variance, you can expect bearish USD index, which means I can look for a sell on the USD index. Like I just mentioned, it is tradable, and that should give me weak USD, but at the same time, that should give me strong, major currencies. That would offer bullish gold at that particular point in time. That should also offer some bullish movement on equities. bullish gold, bullish equities on negative data. So when we have a negative data for the US dollar, we expect bearish USD index. I expect it to go down. If I find a really good, resistance level on USD index, I can also sell it. It's tradable. It is not only for visualizing the performance of the dollar or using it to predict future movements in the dollar. It's not only for that. It could do some other things for you as well. You could be trading it. You can be buying and selling it on the prediction of the strength and weakness of the dollar. If dollar is going to be weak, naturally it spells strength for other major currencies in the market. And then you could also expect bullish gold movement. And then you could also expect some bullish equity movement like US 500, US 100, and US 30. Someone asked a really interesting question in the chat box. Person just said, but yesterday on a weak US dollar from CPI, we still saw equities going down. If you understand one thing about technicals and one thing about the market, when you look at all of those, equity indexes, when you look at them, US 500, US 30, US 100, you see that they are so high. They are so high. They are actually too high. And at the point yesterday, what would be the incentive of buying was not there. So what happened was profit-taking levels yesterday. I think I had an article that I sent to a friend who was also asking the same question. Profit-taking was what happened yesterday on equities. It does not change the fact that they will still continue to rise if dollar remains in weak currency. As long as dollar remains weak, if there's weakness of the dollar, we expect equities to move in opposite direction, which means it is still natural. Those guys that fell yesterday, when you go back to them in the nearest future, you'll see that they are returning back to their peak. Nothing has changed. Someone just asked me a question. How do you trade USD index without pairing it? How do you trade copper? It does not have a pair. How do you trade US oil? It does not have a pair. In this case, you just press new order. It has a minimum lot that you can do. And then you can press your buy and press your sell. It doesn't need to be paired. It has no business with being paired. Zero business with pairing. It's the normal way you trade. Just press new order, press your buy and press your sell. It is key. You see, central banks, really important aspect of trading the US dollar. Not only that, economic data, really important aspect of trading the US dollar. And then finally, before we head for closure, another important thing that you must also consider as a factor that affects the dollar is sentiment. The dollar also reacts according to sentiment. Sentiment plays a major role in the performance of the dollar. Positive market, negative market could also, influence the performance of the US dollar in the market. All right. When market sentiment, when traders, when general market participants are actually positive risk on or negative risk off, we also have influences on the US dollar. The US dollar serves its purpose as a reserve currency during negative or positive market sentiment. In a positive market sentiment, when market participants are positive, optimistic, risk on, the USD is actually a weak currency. That's why it says traders sell the US dollar. So ordinarily, the USD is weak during a positive market. It's a weak currency during a positive market. When traders are more optimistic, really feeling good about the current market condition, risk on, we've always got sentiment. The USD in that scenario is naturally seen as a weak currency. Weakness for the US dollar. Weakness. But on the opposite end, when it comes to the negative market, when you look at the negative market reactions, the USD in a negative market is actually a strong currency. Strong currency. So sentiment also has a way to which it translates to strength or weakness, for the US dollar in the market. It has a way it does that as well. When we have really stringent negative market, you can expect some levels of strength for the dollar. When you also have some really interesting positive market, you could also expect, weakness for the US dollar in the market. So sentiment, also plays a really, really significant role when it comes to the performance of the US dollar in the market. But you see, okay, anyway, we'll talk about that later. When we have, positive market, we expect the USD index to track lower. And we expect a weak USD. But on the opposite end, when we have a really nice risk off, we can expect a bullish USD index. We should offer you a strong US dollar. So this is how sentiment naturally interacts with, dollar and the USD index. So under normal circumstances, in a positive market, nice risk on environment, optimistic market environment, you can expect some bearish movement on the USD index, which means you can look for a sell for a very nice resistance if you find one. You could also expect a weak USD, especially against the AUD and NZD card commodity currencies in the market. When you have a really nice, strong negative market, risk off, something cautious that the market is concerned about, the USD index functions in its full capacity as a reserve currency. You see some bullish movement on the USD index, which means if you find a nice support, you can get in on further upsides on the asset, and that should naturally translate to a strong US dollar. It is important. So now we've talked about how, central banks, their decisions, especially relating to how inflation and interest rates interact, affect the USD index and the dollar. We've also talked about how positive data, negative data could also interact with the performance of the US dollar in response to some other assets in the market. And now we are also talking about how, sentiments, the global market feeling, could also interact with the performance of the USD index and the US dollar. It is key. This really gives you a good picture of, what it really means to trade the US dollar. And one thing you want to make sure you hold on to is to hold on to information. Information from the central bank side, information in terms of economic data, also information in terms of sentiment is key to what you're doing. Your technical analysis must also be sharp, don't forget, because you must also be able to recognize, levels where you can come into the market, how you could also make some certain form of inferences when it comes to trading these assets. The dollar is the most popular currency in the market, so it does a whole lot. If you cannot find the USD index, it's going to be there. All right, maybe you've just not added it. If you're using the system, probably you're not, seeing everything that you have. All right, so let me do something and show you one way you can get it. Just, oh, okay, it's actually showing already, but actually if it's not showing, just press show all. If you're using the phone, it's also simple. Click on plus on the top of your MT4 on your quote window, get into, where you have the type of instruments available, get into futures, you find USD index there, or go into indices, either one of them. It's going to be inside, so you can add it to your screen. It is something that you should definitely have with you, all right, in the place of trading. All right, before I get into some interesting questions and answers, I just want to say that it is important that at the end of the day, we know what we are doing. We understand what is at stake. We know what is currently happening, either on the data front, either on the central bank aspect, or even in terms of what sentiment is saying in the market. But if you're going to rank importance, we need to do it the way we've taken the session today. The central bank aspect of the business determines the long-term movement of the asset. Data also serve as a factor that can corroborate the story from the central bank, or that could also offer us a different insight into how we can predict future price movements for the US dollar in the market. Sentiment could make up for short-term movement in the price of the USD. It's not expected to be a major factor that drives it over a long period of time. Fundamental central banks, economic data are more important in determining the direction of the dollar over a period of time. You can consider sentiment for short-term movements. It is very, very important. And please, you also want to make sure that you're not lagging behind in technicals. You must understand how the market interacts with support and resistance. You must understand how the market interacts with simple price actions. You must understand how buyers and sellers also interact with themselves on the chart, where you can come in as a buyer, where you should not come in as a buyer, where you can also come in as a seller, and where you ought not to come in as a seller, where you need to exit your trades. All of those information, you also need to have them ready-made. Information alone cannot do it. Your technicals must also be sharp. And that's why we've also taught, some really interesting technical topics also on this kind of webinars. We've had price action, trading pullbacks and retracements recorded on YouTube. We have, trading moving average and Fibonacci also recorded for you on YouTube. So it is not enough to be self-sufficient only in the place of information and not understanding how technicals also interact with price. So please, engross yourself in some of those videos, help yourself understand more, but this could be a game changer for you, really understanding what drives the movement of the US dollar and the strong relationship between the US dollar and the USD index.